Retirement interest-only mortgages, or RIOs, might seem like the golden ticket for retirees looking to unlock home equity without selling up. But is it really the smart move? Or just another financial trap dressed up as a solution? Today, we're cutting through the sales pitch, exposing the hidden risks, and revealing the facts lenders don't want you to know. If you're considering a RIO, this deep dive might just save you from a costly mistake. Here's the deal. Retirement interest-only mortgages work like this. You borrow against your home's value, but instead of paying down the loan, you only pay the interest each month. The full loan amount is repaid when you sell, move into long-term care, or pass away. Sounds simple, right? But let's pull back the curtain. First, who are these loans actually for? In theory, RIOs target homeowners over 55 who need to free up cash but don't want the rapid debt accumulation of a traditional equity release plan. Instead of rolling up interest like a lifetime mortgage, you keep things under control by making monthly payments. But in practice, the reality is far more complex. Let's talk about affordability. Just because a bank approves a loan doesn't mean it's a safe financial decision. The Financial Conduct Authority, FCA, requires lenders to assess whether you can afford RIO repayments for the rest of your life, even if interest rates rise or your income drops. But let's be honest, predicting the next 20 or 30 years of expenses is nearly impossible. Take Margaret, a 72-year-old retiree. She took out a RIO to release £80,000, thinking the interest payments were manageable. But a decade later, her pension income was squeezed by inflation and interest rates climbed. What started as a £250 per month payment became £450. With her budget stretched thin, she had to make tough choices: cut essentials or risk defaulting. And that brings us to the biggest danger. What happens if you can't pay? Unlike standard equity release, RIOs don't offer a no negative equity guarantee. Fall behind on payments, and the bank has the right to repossess your home. This isn't some abstract risk, it's happening. According to UK Finance, repossessions among older homeowners are on the rise, with RIO defaults playing a significant role. Now let's talk interest rates. You might see adverts promising RIOs at low rates, but here's what they won't tell you: those rates are often variable. If you take out a RIO at 4% today and rates climb to 7% in 5 years, your payments could almost double. Are you prepared for that? Even if the payments remain affordable, RIOs impact inheritance. Unlike traditional mortgages, where you're slowly chipping away at the debt, with a RIO, the full loan stays intact until it's repaid. This means your estate could be significantly smaller when the home is eventually sold, leaving less for your loved ones. Now let's weigh the alternatives. If you need extra income, a downsizing strategy might be a smarter move. Selling a larger home to buy a smaller, more manageable property could free up capital without taking on risky debt. Equity release lifetime mortgages could also be an option if you prefer a plan where payments aren't required. So, is a RIO ever a good idea? In rare cases, yes. If you have a strong pension income that can comfortably absorb rate hikes and you have a backup plan in case of financial shifts, a RIO can work. But for most retirees, the risks outweigh the rewards. Before making any irreversible decisions, speak to a qualified financial advisor who understands the full picture. Your home is likely your most valuable asset. Don't let a bad financial move put it at risk. If you found this breakdown eye-opening, the next video in this series will be essential for you. Click on screen now to keep uncovering the truth about home equity release.